Liquidity is one of the most misunderstood forces in the financial markets. Most investors are under the impression that prices go up when companies make more money, come up with better innovations, or grab a larger share of the market. While those things do play a role, they aren't what's really driving the bus. Liquidity is. Liquidity refers to how easily money and credit can flow through the system, allowing assets to be bought and sold without causing massive price swings. When liquidity is plentiful, there are buyers all over the place. Transactions happen without a hitch. Prices steadily climb as capital chases after returns. But when liquidity dries up, the opposite happens. Fewer buyers are willing to step up. Selling pressure can send markets tumbling faster and further than most people anticipate. There are two key aspects to keep in mind here. First, there's market liquidity, which is how easily assets can be traded. If you can instantly buy or sell a stock without causing the price to budge much, then that market is considered liquid. Second, there's monetary liquidity, which is more about the big picture. It represents the total amount of money and credit sloshing around in the economy, including things like bank lending, central bank reserves, and all the behind-the-scenes financial stuff that makes borrowing and investing possible. During big bull markets, it's not just strong earnings that are pushing valuations higher. It's also the expansion of monetary liquidity that encourages people to take risks. When capital is cheap and abundant, investors are willing to pay more. That's the fundamental aspect that most people overlook. To understand how liquidity expands, we need to take a look at central banks. Central banks pump liquidity into the system using a few main tools: lowering interest rates, buying government bonds, and expanding their balance sheets through what's commonly known as quantitative easing. When interest rates are lowered, it becomes cheaper for both households and companies to borrow money. Mortgage rates drop, companies issue more debt, and investors start shifting their money away from low-yield savings accounts and into riskier investments. At the same time, when central banks buy bonds from financial institutions, they essentially credit those banks with reserves. Those reserves then increase the banking system's ability to lend money out. The result is a surge in the amount of credit available. After the 2008 financial crisis, central banks put aggressive quantitative easing programs into action. Their balance sheets ballooned, and the system was flooded with reserves. Interest rates remained near zero for years. The impact was clear. Equity markets bounced back and then soared. Housing markets stabilized and started to climb, and venture capital funding poured into even the riskiest ventures. Across the board, risk assets benefited from this wave of liquidity that lifted pretty much everything. This wasn't just because the economy was strong. It was because there was so much capital floating around looking for a good return. What people often forget is that these liquidity injections can be reversed. Central banks can pull liquidity out of the system just as easily as they put it in. This shift doesn't usually happen with some dramatic announcement that the markets are going to crash tomorrow. Instead, it happens gradually through policy adjustments. Quantitative tightening is the name of the game. Instead of buying bonds, central banks start letting the bonds on their balance sheets mature without reinvesting the money. In some cases, they might even actively sell off some of their holdings. When this happens, reserves are pulled out of the banking system and the balance sheet shrinks. At the same time, interest rates are hiked up to fight inflation or cool down an overstimulated economy. Higher rates make capital more expensive across the board. The important thing to remember is that liquidity doesn't just vanish overnight. It drains away slowly. The financial system adjusts little by little. Retail investors rarely notice this shift happening in real time because markets can stay high for months, even years, during the early stages of tightening. Corporate earnings might still look good, and unemployment might remain low. The headlines might be focused on growth rather than contraction. But behind the scenes, the cost of money is rising, and credit is becoming harder to get. The engine that powered the previous expansion starts to sputter. Monetary tightening is only half the story, though. Government fiscal policy can make the effect even stronger. When governments run big deficits, they have to issue bonds to pay for all that spending. And those bonds need buyers. Institutional investors, pension funds, foreign governments, and individual savers all allocate capital to these securities. But every dollar that goes towards government debt is a dollar that's not going into stocks, private investments, or new businesses. This is what's known as the crowding out effect. It's not a huge deal, but it's always there. When bond issuance increases a lot during periods of tightening, it soaks up liquidity that could otherwise be used to support risk assets. At the same time, higher yields are usually needed to entice buyers to gobble up all those new bonds. Rising yields then push borrowing costs even higher throughout the economy. It becomes more expensive for companies to refinance their debt, mortgage payments go up, and consumer credit becomes tighter. The system feels pressure from both sides: monetary tightening from central banks and capital absorption from government deficits. Together, these forces speed up the liquidity drain. The banking system then acts as a transmission mechanism. These days, economies grow mainly through credit growth. Banks create money by issuing loans. When the economy is doing well and rates are low, banks tend to be more relaxed about their lending standards. Businesses expand, consumers borrow to spend, and asset prices rise because credit is fueling demand. But when rates rise and things get uncertain, banks get more cautious. Deposits might decline as savers look for higher yields elsewhere. Regulatory pressure can ramp up, and loan officers tighten their standards. As a result, credit approval slows down. Small businesses are often the first to feel the squeeze. Without access to affordable credit, they have to put their expansion plans on hold, slow down hiring, and postpone investments in new equipment or research. Consumers also change their behavior when borrowing becomes more expensive. Big-ticket purchases get a second look. The housing market cools down. The economy's energy starts to fade, not because everyone suddenly loses faith, but because the easy credit that was driving growth is slowly running out of steam. When central banks tighten the reins, governments issue lots of bonds and banks get cautious. It's like a coordinated squeeze on available money. Each thing makes the others worse. Higher rates mean less borrowing. Bond sales soak up investment money. Banks don't lend as freely. The system gets more fragile, even if things look okay on the surface. Asset prices might keep going up for a while, pushed by momentum or a few leading companies, but the foundation is getting weaker. That's how liquidity really dries up. It's not a sudden crash. It's a gradual process. It doesn't start with panic. It starts with changes in policy, balance sheet adjustments, and subtle shifts in how easy it is to get credit. Investors who only look at earnings reports or the main economic numbers often miss the bigger picture. By the time things get really volatile, the liquidity squeeze has been going on for months. It's important to understand this shift because liquidity doesn't hit everything at once. It moves through the markets in stages. The first signs usually show up in the riskiest investments that rely on easy financing. As things tighten, the effects spread to the broader market indexes, the credit markets, and eventually the real economy. This next stage isn't just a theory. You can see it in how assets behave, how capital flows, and volatility patterns that start to contradict the story of stability. To spot those signs, we need to look at where liquidity pressures appear first and how they spread across markets as the drain gets worse. To figure out where the liquidity drain is headed next, you have to look beyond the main index levels. Major indexes can stay steady for a long time even as things are deteriorating underneath. That's where volatility and market breadth become really important indicators. Market breadth tells you how many stocks are participating in a rally. In a healthy, expanding market, gains are widespread. Small companies, mid-sized firms, cyclical industries, and growth sectors tend to rise together. There's plenty of capital and people are willing to take risks. During a liquidity crunch, that participation narrows. A few big, stable companies start to carry the index. These are the firms with strong finances, reliable cash flow, and global sales. Investors move into safer bets while quietly selling off riskier assets. The index might look flat or even slightly up, but underneath, more and more stocks are declining. Volatility increases in certain areas of the market even if the overall picture looks calm. This isn't random. It's a sign of tightening financial conditions. The first victims of a liquidity crunch are usually small-cap stocks, fast-growing tech companies, and speculative assets like cryptocurrency. These areas depend heavily on cheap financing and aggressive risk-taking. When interest rates are low and capital is abundant, investors are willing to fund businesses that promise future earnings rather than current profits. Valuations go up based on potential. As soon as borrowing costs rise and liquidity tightens, that willingness decreases. Think about a startup that needs outside funding to grow. In a low-rate environment, venture capital firms can raise money easily and invest in early-stage companies. If the startup isn't profitable right away, investors are patient because there aren't many other good returns available. Now, change the situation. Interest rates go up. Government bonds offer attractive returns. Institutional investors can make money with less risk. Venture capital funding slows down. The startup now faces a different reality. It has to cut costs, reduce hiring, or find funding at much lower valuations. Some companies survive, many don't. This happens across the risky investment landscape long before it becomes obvious in established, blue-chip companies. As these high-risk assets weaken, pressure builds in the bond market. When governments issue more and more debt and central banks buy less of it, yields have to rise to attract enough buyers. Rising yields aren't just a number. They directly affect the cost of borrowing throughout the economy. Corporations refinancing debt face higher interest payments. Adjustable-rate mortgages reset at higher payments. Consumers with credit card balances pay more. The housing market often feels this shift quickly. Higher mortgage rates make homes less affordable. Demand slows. Construction slows down. Real estate transactions decrease. Housing is closely tied to consumer spending and confidence. When housing weakens, the broader economy starts to slow down. Businesses react by postponing expansions or cutting back on capital expenditures. The liquidity drain moves from the financial markets into the real economy through higher borrowing costs. This creates a feedback loop. Tighter liquidity weakens economic growth. Slower growth increases the risk of defaults. As risk rises, lenders become even more cautious. Bond investors demand higher yields to compensate for the uncertainty. Higher yields tighten conditions even further. What started as a policy shift turns into a self-reinforcing cycle. The global economy makes this even worse. When interest rates rise in the United States, capital tends to flow toward dollar-denominated assets seeking higher returns. This strengthens the United States dollar. A stronger dollar puts pressure on emerging markets, especially those with a lot of dollar-denominated debt. When their local currencies weaken against the dollar, it becomes more expensive to pay back that debt. Governments and companies in other countries need to dedicate more of their earnings in their local currencies to cover debts they owe in dollars to protect their currencies and prevent too much money from flowing out. Foreign central banks often react by raising their own interest rates. However, raising rates at home can hurt their own economies. That's how tighter money policies in one major economy can spread to other countries. Global trade, commodity prices, and investments across borders all feel the effects. Liquidity is all connected, so a shortage in one area rarely stays isolated. As these underlying pressures increase, investors start to change their thinking. Liquidity trends are closely linked to how people feel. During times of growth, optimism prevails and investors see setbacks as chances to buy. They downplay risks, and stories of innovation and growth are everywhere. But when liquidity dries up, the mood shifts. Market participants become more sensitive to bad news, and companies that don't meet earnings expectations get punished more harshly. Price swings become more dramatic because there are fewer buyers willing to jump in when prices drop. Less liquidity means there are fewer orders in the market and less of a cushion against big price movements. During an expansion, plenty of capital quickly absorbs selling pressure. But in a contraction, that cushion shrinks, and corrections happen faster because there are more sellers than buyers when things get stressful. This isn't just about emotions, it's structural. When credit is tight and capital is scarce, investors prefer to hold onto their cash rather than spend it. The willingness to take risks declines. Sharp market corrections often happen not because one single event destroys value, but because the liquidity situation was already weak. A trigger, like disappointing economic data or political tensions, simply reveals the weakness that was already there, without strong liquidity to support them. Markets reprice assets faster and more decisively. It's important to realize that a liquidity crunch doesn't happen as one sudden collapse. It unfolds gradually across many areas at the same time. Stock markets show narrower leadership and greater volatility. Riskier assets are the first to decline. Bond yields rise as the supply of debt increases and central banks pull back. Housing and business investments slow down as borrowing costs rise. Emerging markets experience capital outflows as the dollar strengthens, and overall sentiment worsens as investors become more cautious. Each of these factors reinforces the others. Stock market weakness reduces wealth, which in turn dampens consumer spending. Slower growth makes lenders more cautious. Higher yields put a strain on government budgets, and currency pressures intensify in other countries. This isn't just one isolated shock. It's a coordinated tightening of financial conditions across all asset classes and countries. At this point, the liquidity crunch becomes the dominant force shaping markets. Earnings reports still matter, and economic data still influences short-term movements. But the main driver is the availability and cost of capital. Investors who don't recognize this environment often mistake volatility for temporary noise rather than a fundamental adjustment. The key question now shifts from figuring out what's happening to deciding on a strategy. When liquidity is constrained and tightening spreads across stocks, bonds, credit markets, and global capital flows, you need to change your positions. The assumptions that worked during the expansion no longer apply. Knowing how to adapt becomes the key to preserving your capital and avoiding getting caught in the contraction. To address that shift in positioning and long-term decision-making, we move into the final stage of the discussion. At this point, it's important to reframe the liquidity crunch correctly. It's not a permanent collapse of the financial system, and it's not the end of capitalism. It's a cycle. Financial history is defined by alternating periods of expansion and contraction. Liquidity expands, risk-taking increases, valuations stretch, and optimism builds. Eventually, conditions tighten, credit slows, risk appetite fades, and valuations compress. The cycle resets. Understanding where we are in that cycle is much more valuable than trying to predict daily price movements. When liquidity is plentiful, returns tend to be strong and volatility is low. Investors are rewarded for taking risks. During a contraction, returns become uneven and volatility rises. Risk is no longer automatically compensated. Adjusting your expectations is crucial. In a liquidity expansion, double-digit annual equity gains might seem normal, but in a contraction, preserving capital might become the primary goal. Investors who don't recognize this shift often cling to outdated assumptions, expecting the environment to behave as it did during easier monetary conditions. This is where a defensive strategy becomes practical rather than just theoretical. In tightening phases, resilience matters more than rapid growth. Companies with strong balance sheets, manageable debt levels, and consistent positive cash flow become more attractive. They are less dependent on outside financing, and they can withstand higher interest costs without having to restructure. Firms that relied heavily on cheap credit to fuel expansion often struggle in this environment. The difference between survival and failure often comes down to balance sheet strength. Short-duration bonds also become more relevant during contraction cycles. When interest rates are high or rising, shorter maturities reduce your sensitivity to further rate increases. They provide income without locking up your capital in long-term securities that could decline in value if yields climb further. Holding higher cash reserves can also serve a strategic purpose. Cash isn't just idle capital during a liquidity contraction. It represents optionality. It gives you the flexibility to act when valuations adjust. This approach contrasts sharply with the strategies used during liquidity expansions. In times when money flows freely, investors often stretch out their investment timelines, take on more debt, and put their money into fast-growing industries. They assume that money will continue to be readily available and that they'll be able to easily refinance their debts later on. But when the money supply tightens, that assumption becomes less reliable. Protecting your capital and staying flexible become the top priorities. However, a shrinking economy doesn't mean there aren't opportunities out there. When liquidity dries up, it can be painful because it reveals vulnerabilities and forces assets to be reevaluated. Overpriced assets drop in value, and weak business models fail. Excessive speculation is weeded out of the system. While this process can be uncomfortable, it also brings valuations back down to more reasonable levels. Investors who are patient and have cash on hand can take advantage of these market dislocations. Imagine an investor who kept a disciplined cash reserve during the boom times. As financial conditions tighten and asset prices fall, that investor isn't forced to sell. Instead, they can carefully pick and choose companies with strong, lasting competitive advantages at lower prices. Historically, periods of contraction have set the stage for the next expansion. Those who put their money to work strategically during downturns often reap the biggest rewards when liquidity eventually returns. The key is to get the timing right and stay disciplined. Opportunistic investing during a contraction doesn't mean recklessly trying to find the bottom of the market. It requires carefully evaluating balance sheets, the sustainability of earnings, and how well a company is positioned in its industry. It also requires acknowledging that volatility could stick around for longer than you expect. Patience isn't about sitting on your hands. It's a strategic approach. Risk management becomes even more crucial when liquidity dries up. Taking on too much debt is especially dangerous in tightening cycles. When borrowing costs rise and asset prices fall at the same time, highly leveraged positions can quickly fall apart. Margin calls and forced liquidations can accelerate the downward spiral. Avoiding overextension protects you from permanent losses. Diversifying your investments across different asset classes also reduces your exposure to any single source of risk. While correlations can increase during times of stress, diversified portfolios generally weather volatility better than concentrated bets. Keeping a close eye on macroeconomic indicators is essential. Trends in central bank balance sheets, credit spreads, and bond yield movements can provide insights into the direction of liquidity. Investors who track these systemic signals are better equipped to understand market behavior. One of the most important insights is that liquidity often foreshadows fundamental changes. Markets may weaken well before corporate earnings start to decline significantly. By the time revenue contraction shows up in financial statements, asset prices may have already adjusted. Conversely, markets can start to recover even while economic data remains weak. Liquidity conditions may improve before the headlines reflect that shift. Investors who rely solely on backward-looking data risk reacting too late. Understanding this timing difference allows for more strategic decision-making. Volatility isn't always a sign of permanent damage. It can reflect the adjustment of capital flows in anticipation of economic data. Recognizing whether liquidity is expanding or contracting provides context that price charts alone can't offer. Ultimately, the Great Liquidity Drain represents a structural shift in capital conditions. It's not just a temporary correction driven by sentiment or isolated events. It's the cumulative effect of central bank tightening, increased debt issuance, cautious lending, rising yields, global capital flows, and shifting investor psychology. These forces are reshaping the investment landscape. Investors who ignore liquidity are essentially flying blind, without understanding the primary driver of asset cycles. Those who study it gain valuable perspective. They adjust their expectations during contractions, prioritize resilience over speculation, and maintain flexibility. And when conditions eventually stabilize and liquidity starts to expand again, they're positioned to participate from a place of strength rather than scrambling to recover. The overarching lesson is clear. Liquidity is the hidden engine of the markets. It fuels expansion when it's abundant and exposes weaknesses when it's withdrawn. When it drains, everything changes: risk tolerance, valuation frameworks, capital flows, and opportunity sets. Recognizing that shift doesn't eliminate volatility, but it transforms how you respond to it. In financial markets, adaptation is survival, and understanding liquidity is how you adapt. Liquidity cycles don't reward emotion, they reward awareness and discipline. If this breakdown helped you see the bigger picture, subscribe and stay ahead of the next shift. This is Charlie Invest, and I'll see you in the next analysis.